right, we are live. Hi, everyone. Thank you so much for joining us for Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I am joined by CNBC's senior stocks correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. How's the summer going?
Summer's going well. It's hard to believe it's already mid-August now, but how about you?
Yeah, we're in the sort of doldrums here of August, which is great. For me, it's a little tough because the volumes tend to lighten up and the traders tend to go away, so there's less people to talk to, but that's good. Everybody's hanging out at the shore, on vacation with their families. It's a good part of the year.
Yes, definitely. So lots of questions this week. Let's jump right into it. First up, what's driving the stock market right now as we're, like we said, middle of August?
Well, we're in the middle of a big rally. I mean, a noticeable rally. We're 15, 16, 17% off the lows that we hit in June. Remember, there was big panic in April, May, June. Everyone thought, oh my God, there's an imminent recession coming. The world's going to go to hell in a handbasket and the economy is going to fall apart and spending is going to stop and the earnings are going to fall apart. And that's the lifeblood of the stock market, as you know, dividends and earnings. And basically, none of this has happened. There is definitely some signs of an economic slowdown. Hiring is slowing down somewhat. Lower-end consumer is under some pressure from inflation, but the economy is not falling apart. And generally, we've gone from, oh my God, there's going to be some kind of terrible recession to, oh, well, it doesn't look that bad. Maybe we're just going to have a very mild recession. And now some people are saying, it's not clear we're going to have any recession. Whatever you think of a recession is, the job growth is just too strong. Now we've gotten some inflation data, the CPI, and today the producer price index, PPI. This is prices on a wholesale level, and both were below expectations. So the bottom line is inflation is still too high, but it's moderating. And that's all you need right now to get a rally. Now, down the road, we'll need further signs that it's moderating even more. It has to. So the battle is not won. The Federal Reserve is right. We're not done. But there are signs we're going to, at worst, have a modest recession, even if that. Earnings are not falling apart. And there is some growing evidence that the Federal Reserve, which is front-end loading all of these rate hike increases you hear about, they're doing it all now. They may be done by the end of the year. We don't know for sure. This is all hopium, but the numbers have been going in the favor of the bulls in the last few days. So there's been really big rallies in some of these cyclical sectors like technology, like I keep mentioning Cathie Wood's ARK Innovation Fund. The thing has just been enormous. It's 55% off of the lows it hit in June. I mean, we're talking, 6 weeks here. The NASDAQ 100, which is a good sort of proxy for technology stocks, that's up 20% off of the June lows. Small caps, the Russell 2000, different group, up 20%. The transports, another completely different group than the NASDAQ 100, that's up 20%. That's a broad rally. 20% is a lot for the stock market to move, considering we were here less than 2 months ago. So that's the good news. The bad news is you're going to start hearing about stocks are too expensive now because the earnings aren't really going up much. They're pretty stable, but the prices are going up. So the PE ratio, the multiple, price divided by earnings, is going up. It was at the bottom in June, 16 times forward earnings. That's kind of a historic norm. Now it's kind of 18 times. And the problem here is that when you get towards 20, a multiple of 20, these are forward earnings estimates. What the PE tells you is how much is an investor willing to pay for, let's say, $1 of future earnings. Right now, in June, they were willing to pay 16 times. Now they're willing to pay 18 times for $1 of earnings. Well, why? Why are they paying more for? Usually the multiple goes up when you can make an argument that either the economy is expanding or the earnings are going to be going up at some point in the future. This is all a guessing game. That's a hard call to make. It's one thing to say we're not going to have a recession. It's another to say, prices for stocks should go up because the economy is going to improve in the fourth quarter or earnings are going to improve. That's a tougher argument to make right now. So you're going to hear in the next week or two that stocks are pricey, stocks are overvalued. Expect this to hear it. But this is what happens. We should have these problems, by the way. This is what happens when you get these kinds of fairly short snapback rallies.
So, Bob, you mentioned the inflation reports that we got this week. What do these reports and numbers mean for the market and for the Fed?
Well, the key here is the CPI and the PPI numbers show moderation. They're still too high. I want to point out the consumer price index year over year for everything was 8.5%, and that's still too high. And the Fed officials are going to keep saying that. And everybody's right. Nobody disagrees. But things are moving in the right direction. So just look at oil. Don't get too complicated. Oil's a proxy for inflation. Oil is a proxy for inflation because it's made into gasoline. And gasoline is often the biggest household expense, one of the biggest ones outside of housing. So when you have gasoline at $5 a gallon, like it was a little while ago, and it was $3.50, that's a major tax on the average consumer. You could be spending $30, $40 more, $50 more a week if you're driving around. That's a lot. That's an impact. But now it's back down. In fact, it's $3.99 today. That's a drop. That's good news. Now, it's not the only component of things. Rents are still high, but there's some signs they're starting to moderate. Wages are still high, and that's an issue. Wages are very sticky. As you all know, if you get a raise, you ain't giving back your raise, right? You're only going to ask for more if inflation is still high. So that's why wage inflation is a particularly sticky problem. And by the way, I'm not necessarily against particularly lower end wage earners making more money. I think that's a good thing. I think for many years they were underpaid, and I think it's good that nobody talks about $10 an hour minimum wage. It's always now 15, and most places it's 18 or 20. I don't think that's bad news, but it does cause prices to go a little higher. So by and large, I think that we are seeing some signs of moderation, and that is a good sign. Remember, all of this started largely because of what happened during COVID. The supply chain problems created all sorts of issues. And yes, the Federal Reserve, having loose monetary policy for a long time, also contributed this to some extent. But we are working through a lot of these problems right now, and the stock market is sniffing that out.
So, Bob, we've gotten a lot of earnings reports in the last few weeks, but one company that I wanted to get into in particular was Disney, which reported yesterday. So what did we learn from Disney's results?
Well, Disney is a really big, complicated company, but in one sense, they're in the cable business. And, I work for Comcast. That Comcast is in the cable business too. Comcast owns NBC. And one thing that's very interesting is cable versus streaming. So everybody knows that the cable industry, the number of subscribers, cable, peaked several years ago, 6-7 years ago, and has slowly been coming down. These are cord cutters, and people have been doing more what they call streaming, using apps to watch. Disney's in both of those businesses. Generally, the cable end of the business has been coming down, the number of subscribers, but the number of streaming subscribers, Disney, the Disney podcasts and the Disney apps, Disney Plus, have been going up, and they've been very successful in doing that. So it was quite striking to me that they're raising prices. They're now trying to get to people who first didn't want to be in cable, streamers, and they charged a fee for that, and generally it was ad-free. Now they're trying to capture more people who don't want to pay the higher prices for ad-free and introducing ad-supported. And so they're going to have two tiers essentially. By the way, everybody is doing this. Why? Because people want to capture the consumer. And if you don't want cable, fine, you can stream. Okay, you got streaming, you don't ad-free, $10 a month too much for you? Okay, you can watch ads and we'll charge you $5 a month or $6 a month. So think about it. Be Disney. What they want is they want eyeballs. They want you watching, and they want you paying a monthly subscription fee. And if it's too much for you, okay, we'll find a lower cost thing, but you'll have to watch some ads. Reminds me of television when I grew up. So that's kind of interesting. The other thing that was interesting is the theme parks. This is a very big business for them. Theme parks were doing very well, and yet at the same time, we saw Six Flags reporting, and Six Flags had disappointing commentary. Now, wait a minute. Six Flags in the theme park business, they're pretty big. Disney's in the theme park business. Disney's theme park business was doing very well. Six Flags was not as strong as people thought it was going to be. And a lot of people kind of twist themselves in the pretzels trying to figure this out. But I think what happens here is Disney theme parks are like destinations. The one in Florida, the one in California, the one in Paris. You got a plan going there. Six Flags are more local oriented, so people can make snap decisions about going to those places. And maybe some people decided, it's expensive, I don't necessarily need to go there. But if I was planning to go to Disney, I'm thinking about this 3 to 6 months in advance, and I've already paid for it. So I think the fact that Disney is more of a destination than something like a Six Flags probably had some kind of impact. But it's a very interesting business. And of course, the Marvel Universe, which Disney bought years ago, continues to do very well. I find Walt Disney to be an amazing company.
So, Bob, something that we talk about a lot on Market Matters is long-term investing, retirement savings, and market volatility. So how can someone who is nearing retirement safeguard their funds in a volatile market?
That's a great question. We've often talked about younger people and what they should be doing, and it's very simple. If you're a younger person, you should stay long. You should have a regular investing program on a monthly, weekly basis. You should take a portion of your paycheck and automatically invest, and don't think about it. If you're 25 years old, 35 years old, 40 years old, don't even think about it, and you can keep the majority of your money in stocks and not worry about bonds. I can only tell you that's what I did. And that is what I continue to do. When you get older, you need to be a little more aware of your risk profile. You need to be a little more aware of when you might need money. And you might want to be more interested in other kinds of investments like bonds, for example, or potentially what we could consider alt investments like real estate to balance out your portfolio. It's all about how comfortable you are. I know people who are 75 years old and they have, 75 or 80% of their investments still in stocks because they believe they're going to live into their 90s. And that's something that older people need to understand. So, I'm in my mid 60s. I am planning to live to 90 years old and maybe 95. Maybe that's wishful thinking, but the demographics suggest that I can do that. And the technology for medical technology is only getting better. So you need to, if you're 60 years old, you need to say to yourself, how old do I think I'm going to live to? That's really the most important question. And we don't know, but you can make a reasonable guess. Maybe your family health history is really bad. I don't know. Maybe you think you're probably not going to make it to 90. Maybe you only think you're going to make it to 75. Okay. Work on that level. Make an informed guess. And once you do that, you have to decide on how comfortable you are with your allocation. And beyond that, do not try to time the market. So if you are, let's pick the number. If you're 70 years old and you have 70% of your money in stocks and 30% in bonds, and I'm excluding your house and other real estate investments, you should try to figure out whether you are comfortable with that level based on how much money are you withdrawing, how much money do you think you'll need. If you think you need 10 or 20% in cash, then you ought to do that. What you should not do is time the market. And what you should not do, and just listen to CNBC's people come on, we have very smart people come on, is don't think, oh, I think I know where the market top is. I'm going to sell, or I'm going to buy more, or I'm going to, at the market bottom in June, we saw people selling aggressively. That's not necessarily very smart. I mean, think about it. It's buy low, sell high. It's not buy high, sell low. And yet people do that all the time. The stock market is the strangest place. It's one of the only places in the world where when you put the merchandise on sale, people sell it. Imagine this. When you go to a clothing store and you want to buy clothes, you want the prices lower when you're buying them. But in the stock market, they don't. They like the prices higher because it makes them feel good because they already own a bunch of clothes, meaning stocks, and they think the clothes, are more valuable. And in theory, they are. But I think you get my point. Whatever you do, don't sit there and say, okay, I'm going to take half of my portfolio, I'm going to pull it out, and then I'm going to stick it back in again, because you're not going to get it right. You're not going to get the timing right. The academic literature on this is overwhelming. Don't do that. Figure out what your comfort level is and then stick to it. And I know that sounds awfully simple, but believe me, Katie, I've got a book coming out we're going to talk about in the next couple of months, and there's several chapters about this in the history of trying to time the markets. And believe me, not only do your average investor don't get the timing right, professional investors do not get the timing right either. It's a major problem, and it goes to a simple fact: the future is largely unknowable. I know that sounds ridiculous, but it's true, and we can talk about this in the next few months. But it's a major. You need to have that understanding if you want to be a successful investor. We'll leave it at that. We'll talk more about it in the next few months.
Yeah, for sure. I mean, definitely good perspective for people to keep in mind there, Bob. So thank you. And next up, something that we have talked about before, but is meme stock mania making a comeback?
Oh boy. Well, the answer is yes and no. So this week, we saw some of the classic meme stocks. We saw AMC, we saw GameStop rally. And why did this happen? There's a couple things that happened here. In the case of AMC, there actually was an event. They announced a special dividend, and that always gets people going because it means you're getting money. So there was actually some fundamental reason for AMC to move. GameStop, not so much. We have talked about GameStop before. I don't want to get any arguments about what the price is. Everyone agrees on a fundamental basis, the price is absurd. It doesn't make any sense. And they've been laying off people. But the stock was 39 a week ago, and it went to 48 on nothing. Why do you have? There is a couple things going on here. By and large, we're in a rally. And in a rally, when you get sudden spurts up, you tend to get the most shorted stocks suddenly move more than the overall market. Why is that? Well, because they're the most shorted stocks. Duh. So there are people out there who are looking for this. If the market's not doing anything and it's going down, then the most shorted stocks, sure as heck, are not going to rally. Nobody's going to do that. But if the market starts moving up a little more aggressively than it normally does, there are people out there who are looking around saying, okay, we know historically that when the market has sudden rallies that are sustained over more than a few days, the most shortest stocks tend to outperform because people are short them, and when they see the overall market lifting, it tends to lift even the most shorted names, and the people who are short them get nervous and they cover. Duh, this makes sense. This is not a stupid idea. So there's people looking around saying, okay, where's the most shorted stocks? And oh, look, GameStop, AMC, they're among the most shorted stocks. I don't know how much of GameStop is 20% of the float is short or something like that. That's high. If you want to know what on an average day, and the average, probably a typical stock, you might have 2% of the float short, something like that, 3%, something like that. If you have 20% of the stock short, 30, even 40%, that's a lot. That's on the most shorted list. You'll get that. And so people notice this. There's a whole army of people looking for things going on in the stock market, and they have programs that'll tell them, oh, look, the relative strength of the S&P is really strong. Like every day it goes up a little bit. And when you do that, there are programs that will tell you on a historical basis, when this happens, most shorted names tend to outperform. Duh. It's not like nobody knows what they're doing here. This is a very well-studied phenomenon. So you had, among them, we had some of the most shorted names besides these meme stocks rally. Now, meme stocks have a group of people around them that are very passionate. And one of the revelations that they had last year was the people looking at AMC were in the chat rooms and said, you know, if we have enough people here, this is a really heavily shorted stock. And if we can drive the price up a little, we can force some of these people to cover. And this was the fundamental revelation, and it's not a stupid idea. You can. Now, you have to be careful about accusations of collaboration and collusion, but I find it I would find it unlikely that the SEC would try to go after a bunch of people in a chat room and say, you're colluding. I think that's probably unlikely to happen. So this is a long and short way of saying that I think what happened in the meme stocks, it kind of got caught up with a short covering rally that occurred because the overall market is moving. Although in the case of AMC, like I said, there was some fundamental news associated with that.
So Bob, another topic that our audience is very interested in, obviously, is crypto. So there's new crypto ETF. What can you tell us about that?
Well, I had them on. I think very highly of Charles Schwab. They're a wonderful company, and they had a new ETF out this week, the crypto thematic ETF. The symbol, I'm sorry, I'm looking down here, STCE. STCE is a symbol here. And I had David Botset on from Schwab to talk about it. It's interesting that there were a couple of these launched recently, even though, Bitcoin's down 60% from where it was a year ago. The interest still kind of keeps going on. Last week, BlackRock announced it was teaming with Coinbase to offer Bitcoin to institutional clients. That's a real sign to me. I mean, BlackRock is a pretty careful organization. They're not going to stick their neck out, and there's reputational risk here for them and make themselves look bad if they didn't think they had at least some reasonable cover. Now they're selling Bitcoin, only Bitcoin, nothing else, and institutional clients. So it's not like, any Tom, Dick, and Harry can buy it, but it's a sign of a somewhat broader acceptance. So the problem with these thematic ETFs is, and in small areas, is you can't really capture much because there isn't much to buy. This happened with the pot stocks, by the way. Remember this like 4 or 5 years ago? There's nothing to buy. And people owned a lot of nonsense. So here you have the usual names. They don't own Bitcoin. They own companies. So they own MicroStrategy. Everybody knows that. They had a huge position in Bitcoin. The CEO just stepped down. Marathon Digital, Riot Blockchain, Coinbase, Silvergate Capital. That's an investment, the crypto investment organization. Robinhood. See, everybody knows these names. You can name them on 2 hands, and that's about it. I'm talking about companies that have real exposure to the crypto community. There's a lot of other companies, that have peripheral exposure, but not much. So this is a problem. There's not a lot out there to buy. There's no Bitcoin ETF, so they're discouraged there. So, people are roaming around. Anytime you get a modest rally off the lows, even as much as Bitcoin's been beaten up, trying to buy in. To a certain extent, there's a small community very dedicated to blockchain, and I think it's a wonderful technology. I am bullish on blockchain. I am bullish on decentralized finance. And then there's a whole bunch of people who are just basically get rich quick people. Let's be honest about this, okay? And they don't know or care. They just smell that they don't care about blockchain. They don't care about the technology. They just smell that there's a lot of volatility here and they can make some money fast. And there's nothing wrong with that. People in the stock market all the time buy stuff they don't even understand, just thinking that it'll move up fast, and that's all they want. Just be on the right side of the trade. There's nothing wrong with that. But I think a better strategy, if you're interested in this, is to figure out what kind of technology you believe in. And I'm a believer in new forms of financial technology. 40, 50 years ago, we had futures come in a big way into financial. You always had futures in commodities, but in financial stocks, financial instruments like the S&P 500, no, that didn't exist that long ago. And those were wonderful innovations. They enabled people to hedge. And same with the options business. Options is not an old business. It's only around really since the 70s and 80s where it really kind of took off. That's financial innovation. And so you need to believe in financial innovation. That doesn't mean you need to buy every silly fad that's out there. A lot of people got burned by Bitcoin. But the underlying technology, oh yeah, that's very powerful. So people ask me all the time about the price of Bitcoin. I'm totally agnostic. Don't ask me. It doesn't have any real value at all. It's only worth what people are willing to pay for it. I've said this many times. There's a Rolling Stones poster behind me. I collect old rock posters. What's this poster worth? The answer is whatever anybody would pay me for. I could tell you roughly because I know dealers what somebody would pay me for this because based on past experience, but it doesn't have any intrinsic value. It doesn't pay a dividend. It doesn't have a future stream of earnings. It doesn't do anything. It just sits on the wall. And it's a pretty thing, and you can collect it. You know, Bitcoin is kind of the same way. It's worth whatever anybody wants to pay for it. But the technology behind it, blockchain technology, is tremendous and enormous applications beyond cryptocurrencies. And that's why I'm bullish on that kind of financial technology. And I don't have a strong opinion about Bitcoin at all. So I guess what I'm saying is believe in the technology, and you know, you can have an opinion on Bitcoin if you want, but I would stay with the long-term financial concept of financial innovation.
Well, it'll certainly be interesting to see how things, continue to unfold in this space, how these crypto ETFs perform as we go on long term. So thank you, Bob. Thanks again for answering all of our questions. Thank you to everyone for sending in questions.
Considering it's a boring week in August, actually, it's been very eventful. The CPI and the PPI were very big news, and the market is moving up. And the big question now is, how much more can it move up? You're going to see this weekend a lot of people coming out writing, who are professional financial writers, that the market's expensive, and it is. It's starting to get very expensive. But considering it's August and it's normally pretty boring, this is pretty cool action, actually.
Yeah, for sure. Well, we'll definitely be watching that, and we'll check in with you again in a couple of weeks for all the updates. So
thank you. Thanks, everybody.
Talk soon. Bye.